Joining us now is RBC Capital Markets Head of U.S. Equity Strategy, Lori Calvasina. It's nice to see you, Lori, here at Post 9. Why the change?
So, look, I've been out talking to investors for the last couple months, pretty much nonstop on the road. And, you know, we go through the numbers. We're very data driven. And we felt like we had started to see a real turn in the earnings landscape. And so we upgraded our earnings estimate. Once we went through that model, it changed some of our target assumptions. Our multiple assumption didn't really change, but the earnings number helped push up some of the numbers in our modeling process. So I would say it was largely earnings driven. We are starting to see a recovery in the rate of upward revisions. You hit 57% upward revisions on the S&P last week. We've got broad participation by sectors. We think we've turned the corner on that earnings story. And it's funny, Sarah, I mean, I keep getting accused of being this wild bull, which is, you know, kind of uncharted territory for me. Usually I'm the voice of caution. But we did feel like we wanted to communicate the story that we think the market move has been very rational. Some of our models point to upside to 4,400 to 4,600. So we wanted to really communicate that this has been a rational market. We're not big bears. We might overshoot our target a little bit, but, you know, we do think valuations have gotten kind of close to where they need to be.
You know, there's such a strong case, I think, for the bulls and for the bears now. We just had Bob Dahl on in the last hour from Crossmark, very cautious on earnings risk, says it's not priced into the market. If you look at leading indicators, for instance, this long streak signaling recession, the inverted yield curve, the liquidity issues, there's bound, the lagged effects of Fed policy, there's bound to be a hit to the economy, which is going to hurt earnings.
I think that what's surprising people a lot is both the resiliency of consumers and the resiliency of corporate America. I think the resiliency of corporate America, you know, I think it's the Duke CFO survey has a great time series where they ask about the optimism on the economy and the optimism about your own company. In the last few years, the optimism on their own company has far outstripped the optimism on the economy. And it's a testament to the fact that management teams are really, really good at navigating crises. And you think of everything we've thrown at corporate America since the trade war, the pandemic, supply chains, inflation, Russia, Ukraine, SVB. They've got some confidence, and I think they deserve it. And there's a psychological element to a recession that we all forget about. It's kind of like the snowball effect. Consumers get worried and scale back. Corporations get worried, and they start firing people. Well, guess what? They've got another lever they can pull right now, which is wage growth. And as we're seeing some of the labor market stats starting to deteriorate, you're seeing companies actually say, hey, the labor backdrop has gotten easier. So they don't have to go right away to firing people. Consumers have these great cushions. They don't have to get as scared either. And that throws, for people like me who model and are all about data, throws the models off.
Yeah, there's no doubt the cycle is definitely causing people to adjust the way it's playing out. You say, though, you think valuations are roughly where they should be, right? Your target is essentially where the market is at the moment, at least at the S&P level. I think the question really is, did we reset last year in terms of valuations, in terms of pricing in an earnings downturn, to the point where forward returns are really good, as they usually are after a bear market?
I think we did, and this is a big point of confusion on the street. Your average investor is going to say, we need to be trading at 15, 16 times. And I think that math works if you're looking at a model based on a post-financial crisis environment and you're using 10-year Treasury yields as the single variable that you're looking at. I have a model that, frankly, you know, it goes back to 1962. It bakes in inflation, it bakes in the Fed, it bakes in 10-year, it bakes in GDP. And that long-term history and baking in that, you know, sort of more angsty inflation rate environment of the 70s and 80s gives me a different number. So it gives me about 21.8 times. You know, I tell people it's a compass. It's not a GPS. It's not a precision tool. But it tells me multiples can be meaningfully higher than where most people have assumed. And we got down to kind of a 16, 17 multiple at the October low last year. I think that was good enough. And now we're in expansion mode.